All right, greetings everyone. So I want to talk about a study that I did about a year and a half ago where I looked at the delta or the difference between where the market closed during the previous trading session and where it opened during the next day's trading session. So let me pull up my pointer here so I can effectively demonstrate what I've done here. Okay. So let's just say, for example, let's just say today is September the 7th. So what I did was, let's say the market closed on September the 6th at 38.50. That's where it closed. And on September the 7th, it opened at 38, let's just say 65. So that's where the market opened. For those who aren't aware, the market opens at 9:30 a.m. Eastern Standard Time. Right, so the delta or the difference between the previous day's close and the next day's open is 15. Okay, and so now let me just change my color here. All right, and then I also looked at, okay, so now that the market is open on September the 7th, where did it close? So let's say the market closed at 38, I don't know, 40. That's where it closed on that particular day, September the 7th. So when you compare that with where it opened to where it closed, you're talking about a negative 25, right? So I did a scatter plot diagram of both of these comparisons, right? So I went back to January of 1980 up until September of 2022, right? So over 41 years worth of S&P 500 data, of market data, right? And so again, this chart, this scattered plot diagram looks at, comparing the previous day's close with the next day's open. So looking at the delta or the difference. And so as you can see here, on average, the market opens plus or minus 50 points up or down from the previous day's close. Right. So as you can see here, there are some outliers. For example, this particular data point represents a 107 point move. So that was March 24 of 2020, and so we know what took place then, right? That was the pandemic. That's when the pandemic was announced by the WHO, the World Health Organization. And so, of course, that caused a lot of market volatility, but that's an outlier. That's not a usual move for the market, right? On average, the market, when it opens from its previous day's close, will open no greater than plus or minus 50, right? So that's really, in my opinion, important information to have, considering, particularly if you are looking to put on a uh, a 1 DTE or a 2 DTE, or a trade that will last more than the actual day. If you're not just day trading, and if you're trading overnight, then understanding where the market could potentially open the next day with respect to whatever strike prices you select for your call options or your put options is very important. And so the next graph actually looks at, okay, so now that the market is open, where does the market close with respect to its opening price? And so again, as you can see here, on average, the market moves up or down roughly 50 points, right? Because as you can see here, most of your points fall within plus or minus 50. Now, again, a lot of these outliers where the price moved more than 100 points in one trading session, again, they correspond to, the beginning of the pandemic, right? So the beginning of the pandemic in 2021, particularly in March of 2021, the media propagation about, this deadly flu virus, it caused a lot of volatility in the market. So it's not surprising that, you have these outliers here, that correspond to, certain news events. But nevertheless, on average, the market moves in any given trading session up or down 50 points. So again, this is important information to have at your disposal, because again, it helps you to understand, or it gives you a reference point for when you're looking to select your option contracts, right? Whether it be a put option or a call option. So yeah, and this is looking at over 41 years worth of data. So again, having this information, doing these studies, and also I don't just, so this is not the only information I use to gauge or to inform me of which strike prices I need to select. I'm also looking at indicators during the actual trading session as well. Right, so just to give you guys a visual. So today is October the 2nd, so it's Sunday, so the market is closed. So when the market closed on Friday, it closed at 35.85, right, and some change. So based upon what I just showed you guys, we can suspect that when the market opens on Monday, October the 3rd, that it'll open anywhere between plus or minus 50, right? Because on average, the market opens up or down roughly plus or minus 50 points from its previous day's close. So we're talking about the market potentially opening anywhere between, let me just pull up my pointer here. So anywhere between, so we're talking about plus 50, so plus 50 would be 36.35, and minus 50 would be 35.35, right? So the market could open anywhere, on average, anywhere between 35.35 and 36.35. So now, had you on Friday, right before the market closed, decided that you wanted to put on a trade that expires on Monday, October the 3rd, then knowing that the price of SPX on average opens the next day up or down 50 points, then it would have, behooved you to select, for example, let me just close this up. So select, for example, on the put side, you want to get, beyond that negative 50 point potential move, right? Potential open price on the SPX, right? So anywhere you can say 35.15 and 35.10 if you're looking to put on a vertical put credit spread. And so that will put you outside of the average expected move of the next day's opening price of plus or minus 50, right? Because the negative 50 move will be down to 35.35 with respect to its closing price. And then, of course, during the trading session, again, we are still expecting, a move of roughly plus or minus 50 up or down. So again, and that now I've been trading these same day expiration trades, these 0 DTE trades, and so I'm looking to get in and get out on the same expiration date. So I have not been trading for the most part overnight option contracts. And so I've been essentially, so for example, I would wait until the actual trading day, which is October 3rd, which is Monday, and then see where the market price opens. And then from that point, looking at some other indicators, the advanced declining indicator, the tick, and also the volume up or down indicator to determine where I need to be, whether I need to be on the put side or on the call side. But again, as you guys saw in the graphs in which I displayed, on average, the price of the underlying during the actual trading session will move up or down 50 points, and so you can pretty much bank on the fact that it's going to stay within that price range. Now, of course, considering the high inflation environment in which we are in right now, the market is really sensitive to any kind of news that pertains to the rate of inflation, the CPI, the Consumer Price Index, and also any of these Federal Reserve governors, making comments about the interest rate. So the market is very sensitive to that kind of information right now. So there's always a possibility that the market could actually move beyond that average price movement up or down 50 points. So just keep that in mind.